$400,000 paid off. No mortgage, no payment, keys in your hand. 15 years from today, if you keep living in that house, it is worth about $774,000. If instead you sell it, rent an equivalent place, and put the leftover equity into a broad index fund, you end up with about $925,000. So selling wins by roughly $151,000 over 15 years. Now, here's the part that should bother you. The version of this comparison that circulates in comment sections says the gap is $780,000, not $151. $780. That number is wrong by a factor of 5. And it is wrong because of one line item, the rent the seller has to pay, which that version leaves out of the sell column entirely. We are going to put it in. And one more thing before the arithmetic starts. If you are the median late career homeowner in this country, the concentration decision you think you are about to make has already been made. Owner's equity as a share of all United States housing value has been above 71% for 11 straight quarters. At the 75th income percentile, home equity is about 84% of household net worth. This is not a goal to reach. It is a position you are already holding, okay? Rules. Because a scorecard without rules is a sales pitch. Same house on both sides. You do not downsize, you do not rent it out, you do not open a home equity line, you do not take a reverse mortgage. The person who sells rents a comparable place, same neighborhood quality, same square footage, same school district. Both columns run 15 years. Both are in nominal dollars, so they are in the same units, which sounds obvious until you watch someone compare a real house return to a nominal stock return and declare a winner. The base case runs the house at 4.5% nominal and the index at 10% nominal, with rent and carry both escalating 3% a year. Every other lane in this video changes exactly one of those numbers and holds the rest still. And hold on to this, because it comes back. Both of these people have to sleep somewhere. Start with the column that looks empty. Free and clear is not free. Property tax on a $400,000 house at the roughly 0.99% national average effective rate is about $4,000 a year. Insurance, using the national figure of $2,003, call it $2,000. Maintenance at 1.5% of value, the middle of the standard 1 to 2% planning band, is $6,000. $12,000 a year, escalating with inflation, leaving your pocket forever for a house you own outright. I want to be fair here, so I am being generous to the house. The national composite for what a single-family owner actually spends runs closer to $15,979 a year, about $10,946 of that maintenance and upkeep. $2,003 insurance, $3,030 tax. I am using $12,000. That is the number friendly to keeping. Remember that I made that choice. So the house costs you $12,000 a year. What does it pay you? Not appreciation. You cannot spend appreciation while living inside it. What it pays you is rent you do not write. And that number has to come from the actual market, not from a feeling. As of July 2026, median asking rent across the 50 largest metros was $1,695, down 1.4% year over year, the 36th consecutive monthly decline. The two-bedroom median was $1,893. The Zillow Observed Rent Index, which is broader, sat at 1,962, up 2.3%, the fastest pace in over a year. Both of those are apartment weighted. You are not renting an apartment in this scenario. You are renting a detached house. So I'm setting the comparable at $2,400 a month, $28,800 a year. Subtract the $12,000 of carry, and the paid-off house delivers you a net benefit of $16,800 in year one. That is real. That is the honest case for keeping. And it gets counted exactly once as cash flow, not as a yield on $400,000 of equity, not as a return, not as both. The house is a shelter machine. It produces shelter. It does not produce shelter and a portfolio return at the same time out of the same asset. By the way, if you are the kind of person who likes housing math with the vanity numbers stripped out, subscribing to Lazy Investor genuinely helps, thanks to everyone who does. Now the other side, starting with the objection everybody leads with, taxes. Selling costs you real money. Commission runs 5 to 6%. Closing items another 1 to 3. So the honest friction band is 6 to 10%. I will use 7. $28,000 gone at the closing table. You walk with $372,000. The federal capital gains bill on that sale, for most of you, is 0. Section 121 excludes $250,000 of gain if you are single, $500,000 if you file jointly, provided you owned and lived in the place 2 of the last 5 years. You can use it once every 2 years. On a $400,000 primary residence, that exclusion swallows the entire gain in the overwhelming majority of cases. That is the objection people give me most often for not running this comparison at all. It is dead in 3 sentences. And keep it in mind, because it is also about to turn out to be the least important number on this page. So, $372,000 into a low-cost fund tracking large American companies, 0.03% in fees, 10% nominal as the base case, 15 years, nothing touched, $1,554,000. The house at 4.5% nominal ends at $774,000. That is the headline. 2 to 1. That is the number in the comment that says sell the house and put $200,000 in a growth fund. And it is fiction, because the person holding $1,554,000 has been sleeping in a car for 15 years. Both of these people have to live somewhere. The homeowner pays $12,000 a year and gets a roof. The renter pays $28,800 a year and gets a roof. The different $16,800 in year 1 has to come out of the portfolio, because in this scenario, the portfolio is the only pile that exists, and rent does not stay still. Escalate it 3% a year, which is roughly what shelter costs have historically done. 15 years of that withdrawal, compounding against you the entire time, removes $629,000 from the terminal balance. $925,000. Not $1,554,000. That is the line item. That is the factor of 5. The margin is not $780,000. It is $151,000 over 15 years. And suddenly, this is a much more interesting argument than either camp wants it to be. A margin that thin invites an obvious question. Which assumption breaks it? Start with the one people reach for, closing costs. Push friction from 7% to the top of the band, 10%, and you invest $360,000 instead of $372,000. The portfolio ends at about $875,000. The margin falls from $151,000 to $101,000. Doubling the transaction friction moved the answer by $50,000 out of $900. It did not change the verdict. Closing costs are the thing everyone argues about, and they are not the lever. Suspect eliminated. Here is the lever. Nominal American home price appreciation swings hard by decade. 2.4% a year in the 2000s. Roughly 8.4% so far in the 2020s. Go back to the 1970s, and it ran 10.3. Adjusted for inflation, the whole record mostly sits between 0 and 3.3%, and it was around 0 or negative in the 80s. And again in the 2000s. Run your house at the 2010s rate of 2.4%, and after 15 years, it is worth $571,000. Run it at the 2020s rate of 8.4%, and it is worth $1,341,000, and keeping wins outright by a lot. So the verdict does not merely shrink, it flips, which means picking a point estimate for house appreciation is not analysis, it is choosing your conclusion first. Fine. Then stop guessing. Fix the house at 4.5% nominal, which is close to the long-run average, and ask a different question. Not what will stocks do? Instead, what does the market have to deliver for the 2 columns to tie? Because that number is a fact about the structure of the trade, not a prediction. And it ends this argument. About 9% nominal, over 15 years, net of fund fees and net of every rent check you write along the way. 9%. The long-run nominal average for large American stocks is around 10. So the entire $400,000 decision run, honestly, comes down to a cushion of roughly 1 percentage point a year. In dollars, at 9%, you break even. At 10%, you are ahead by $151,000. That is not a slam dunk. That is a coin with a slightly heavy side. Now, Why does the standard planning conversation leave this line unscored? Because of how the retirement conversation is structured. And I do not think it is bad faith. Home equity is roughly a third of retiree financial assets, more than the quarter sitting in retirement accounts. Median home equity for older households runs around $130,000 against median retirement savings closer to $40,000. The house is the biggest number on the page. And it is the one number that never gets scored. The 4% rule gets applied to the smaller pile: withdrawal, sequencing, asset location, Roth conversions, all of it aimed at the accounts. The house sits in the corner marked solved. Price the incentive and it stops being mysterious. An advisor charging 1% of assets under management earns nothing on your $400,000 of equity. Move it into the portfolio and they earn $4,000 a year on it. That cuts both ways. And it is exactly why you should not take either answer from someone paid on the outcome. It is not a conspiracy. It is a fee schedule that quietly decides which assets get analyzed and which get called settled. Nobody has to lie for the biggest line on your balance sheet to go unexamined. So let us examine it properly, which means abandoning averages entirely. A 1 percentage point cushion built on a long-run average tells you nothing about the 15 years you actually get. There has never been a negative rolling 15-year total return in the historical record for large American stocks. That is the good news. The bad news is that plenty of those 15-year stretches landed nowhere near the 10% average, well under the 9% you need here. Run a weak lane, 5% nominal. The 372,000 grows to about 770,000, and then 15 years of escalating rent take 434,000 out of it. You end with roughly $336,000. The house, meanwhile, is still a house, $774,000. The margin swings from plus $151,000 to minus $438,000. And notice why. The rent withdrawal does not care what the market did. In a bad decade, you are selling shares into weakness to pay a landlord who has never heard of your portfolio. That is sequence risk with a mailing address. Run it the other way for completeness. 12% nominal, and the portfolio lands near $1,305,000 ahead by $531,000. Here's the part that actually decides this, and it is not the average. In the worst lane, the seller has about $336,000 and is still writing a rent check every month at a rent that has grown for 15 years. In that same lane, the owner has $774,000 of house and is living inside it the $438,000 gap I just gave you, except one side of it is a roof. Those two outcomes are not the same kind of thing. The selling path has the higher expected value and the dramatically lower floor. That is the trade. Not risk versus safety, a higher mean bought with a lower floor. Second thing, and thank you to everyone who has clicked subscribe on this channel while I run these, it does help. Because the owner's floor is not fixed either, and this is where the generous assumption I made earlier comes due. I gave the house $12,000 a year of carry. In the real national composite, it is closer to $16,000. Combined ownership costs rose 4.7% year over year, against incomes up 3.8%. Home insurance is up 48% in 5 years. Effective property tax rates run from 0.29% in Hawaii to 1.88% in New Jersey and Illinois, which means the same $400,000 house costs about $1,160 a year in one state and $7,520 in another. And maintenance is a percentage of a rising value on an aging structure, which means it grows twice. Owning the house outright makes you immune to a landlord. It does not make you immune to housing cost inflation. Your floor is high, but it is not level. It tilts. And the door only swings one way in practice. 30-year money is around 6.66%. So if you sell and change your mind in year 6, you are buying back into a market that moved without you, with a mortgage. That exclusion you used is available once every 2 years. This is close to a one-way decision, which changes what your job is now. For 30 years, your job was to build equity, pay it down, hold on, do not touch it. That instinct worked. It is the reason you are looking at $400,000 with no lien on it. But the job is finished. The new job is not accumulation, it is allocation. deciding what work that equity performs for the rest of your life. Staying in the old role is not free. It costs about $151,000 of expected wealth over 15 years, which is roughly $10,000 a year of equivalent saving, and you pay it whether you decided to or not. So here's the completed card. Keep the paid off house, $774,000 at year 15, $16,800 a year of net shelter benefit in year 1. No compounding on the equity. A carry bill that grows, a floor of roughly $571,000, and a roof. Sell, rent, index, $925,000 at year 15 in the base case, on a required return of about 9% against a long-run average near 10. Range from minus $438,000 to plus $531,000 relative to keeping. $151,000 over 15 years, about $10,000 a year. That is the price of never receiving a rent increase letter again, and of a floor that does not depend on what the market does while you are 72. The house is either a wealth decision or a lifestyle decision, pretending it's both, is how the math breaks. $400,000 of equity sitting under your own roof is not compounding, and it never was. It is buying you a floor. Buy the floor on purpose at $10,000 a year, and you have made a decision. Call it an investment, and you have made an excuse.